Thank you for joining us today for part 3 of our 4-part webinar series, helping investors build a strong foundation for investing in real estate syndications. In today's webinar, we will focus on the different offering types, documents, and the fees and profit splits. You should be receiving the recording if you have registered. If not, please reach out and we will get them to you. If you have any questions, go ahead and pop them in the Q&A box and we can answer them at the end of the presentation. A little bit about us. Break of Day Capital is an experienced value-add multifamily operator focused in the high-growth markets in the Southwest with over $250 million in transactions. Our mission is to deliver superior risk-adjusted returns to our investors while safeguarding their precious capital and provide a quality community for our residents that positively impact their lives. The American Apartment Owners Association recently named us the best real estate syndication company in 2022 for our asset management expertise. We are grateful for that recognition, and it is a testament to our strong focus on operations. A little bit about me. I've been an active investor in single-family and small multifamily rentals since 2003, having benefited significantly going into the 2006 real estate bubble and surviving the subsequent crash after the 2008 great financial crisis. I've also been passively investing in a variety of commercial real estate syndications, including 6 deals with Break of Day Capital since 2017 as a way to scale our real estate portfolio, leveraging experts in different markets without taking on more landlord duties. Prior to focusing on real estate full-time, I spent over a decade in the traditional investment management business with multiple market cycle experience. I love to talk about all types of investing, and in particular, multifamily syndications. As Director of Investor Relations with Break of Day Capital, my goal is to share my decades of investing experience to help as many investors as I can in their journey to financial freedom. We'll go ahead and get into the topics today. There are 2 main types of private placement offerings: Regulation D 506B and 506C. In the US, you are required to register your investment offering with the SEC when raising outside capital. But it is a long and expensive process that is not well suited for real estate syndication, so the SEC allows an exemption subject to certain conditions. The Reg D 506B allows both accredited and non-accredited or sophisticated investors, but the sponsor cannot advertise the deal. The sponsor team will generally require the investor to have a prior relationship with the sponsor as proof that they did not solicit the deal. So it's not so much that you're required to have a prior relationship. It's just that sponsors will often want to establish that relationship with you upfront, not only to get to know you better, to understand your investment goals, but also it's proof that we didn't just show you we didn't just solicit the deal to you if it's a 506B offering. On the other hand, there's a Reg D 506C offering that allows only accredited investors, but the sponsor can advertise the deal. In addition, the investors must provide third-party verification of their accredited status. Usually, it's a letter from your CPA or your attorney, or there's various online services that will provide you with a third-party letter if you submit your documents. There are various qualifications to be accredited investor, and one definition is an individual who made at least $200,000 annually in the past 2 years and expect to make the same in the current year, or has a net worth of at least $1 million excluding principal residence. I also recently learned that there's another way to becoming an accredited investor, which is to become a licensed broker-dealer by passing the Series 7 and 63 license, the exams. You don't have to be a practicing broker-dealer, but having those licenses allows you to be an accredited investor. Finally, I want to end by saying that there's a third type of offering that is lesser known. It's called Reg A Plus, that allows both accredited and non-accredited investors while allowing public advertisement, but has a lengthy and more expensive registration process, so you probably won't see it as often. Now, There are three legal documents that you will need to review when you're looking at syndications. Make sure that when you're investing in a syndication that you are seeing these documents and are properly written by real estate syndication attorneys. Those documents provide the legal framework for the investment and provide evidence of your ownership and rights. Not having these documents is a huge red flag. The private placement memorandum is a comprehensive document that contains all of the details about the investment, the terms, the fees, capital structure, description of the business, past and pro forma financial statements, management team, and all risks associated with the investment. The PPM provides a lot of disclaimers to dissuade the investors from proceeding. The operating agreement is the governing partnership agreement that includes provisions relating to contributions, capital accounts, allocation of profits, losses, and distributions, management, voting, limitation on liability and indemnification, books and records, anti-dilution protections, etc. Finally, the subscription agreement is where you sign up for the investment should you decide to proceed with the investment, and it provides evidence for your ownership percentage and the dollar amounts invested. The subscription agreement should be fully executed by the investor and the sponsor, and as mentioned, it's proof of your ownership of the investment. If you are unsure about any of the terms or conditions of the legal documents, ask the sponsor to explain them to you or consult your own attorney. Sponsor fees. The sponsorship team is responsible for the entire investment lifecycle, and the whole period can take between 3 to 5 years or even longer. Typically, sponsors do not make the bulk of their profits until the successful exit of the asset. And in order to pay for the overhead during the whole period, sponsors will charge a variety of fees to keep the lights on. These fees are typical and the amount should be reasonable. Acquisition fee is to compensate for the significant time and effort required to locate the right property, secure the appropriate loan, handle escrow responsibilities, putting earnest money deposit at risk, and perform due diligence and underwriting. This is a one-time fee and can range between 1 to 5% of the asset purchase price. You would expect to see a smaller percentage for larger deals and a larger percentage for smaller deals. Loan guarantee fee is to compensate the GP and or the KP for taking on the risk of repaying the loan, which can sometimes have personal recourse. This is a one-time fee and can range from 1 to 3% of the loan amount. Sometimes there's a refinance fee, and it's typically around 0.5% of the loan amount. Finally, another typical fee that you'll see is the asset management fee, and it pays for operating and managing the property, such as the time spent managing the property management company. This is a continuous fee and ranges in the 2 to 3% range, 2 to 3% of the effective gross rent collected. Be aware that there are hidden fees or less common fees that sponsors may charge. A disposition fee is a charge to prepare the property for sale and is typically 1% of the sale price. Some sponsors pay capital raising fees or commissions to broker dealers and may pass the cost to the investor. This is less common in the syndication space, but typical in DSTs. As it relates to profit splits, sponsors typically make the bulk of their profits when the deal has successfully exited. There are infinite ways in which the profit split, or in the industry commonly referred to as the waterfall, can be structured depending on a variety of factors such as the experience of the sponsor, or even the scope of the value add business plan, just depending on how much of a lift there is to execute the business strategy. One common waterfall that is ideal for everyone is one that prioritizes de-risking investors' capital by giving them their capital back plus a high hurdle rate before the sponsor gets to participate in the profits sharing. And it's also incentivized to outperform by earning a higher split should they're able to hit certain target investor return target. So the way that it works is usually using this kind of waterfall. The investor receives all of their capital back first, plus the high hurdle rate, sometimes referred to as a preferred return, which is typically in the 7 to 8% range. And then after that, there's a 70-30 split between the LP and the GP until the LP receives a certain the next target, the next hurdle, the next waterfall. In this example, 15% IRR. And then after the investor gets the 15% IRR, then it's a 50-50 split between the LP and the GP. And so therefore, as suggested earlier, the GP is incentivized to outperform by being able to receive a higher profit split. So when you see on the screen here, these are the types of expected returns that commiserate with the type of investment strategy and the risk involved. You'll tend to see the lower IRRs for stabilized yield plays, and then you'll see a lot higher IRRs for something riskier like a ground up development. One tip here is don't compare deals based on projected returns. The pro forma projected returns is a wild guess at best. The most important thing is to bet on the right sponsor with a strong track record and operational expertise. Just by way of example, I recently saw a Class A stabilized luxury apartment deal that has very little upside, and it was being advertised with a 23% projected IRR. And using this example or showing from the example that we're showing on the screen, it is highly suspect. So it kind of makes you wonder, why the sponsor has to promote with such a unrealistic projected IRR. So just to illustrate that point. Here is an illustration of how passive investors might receive their total return over the whole period. What you're seeing on the screen here is not including the tax benefits from depreciation that can be used to offset your taxable gains. And you can see that you kind of start with no to low cash flow, and the cash flows increase as the property is transformed and reaches stabilization, ending with return of your capital plus the profits received from the sale. Distributions can either be made quarterly or monthly. The emphasis that we want to make here is be aware that it is typical for value add deals to either make little to no distributions in year one, as you saw previously in the illustration. This is because as you're executing on the business plan, there's likely to be unit turnovers, and the occupancy rate could temporarily dip to the lower range and within the first couple of years. So although the property is likely to be cash flowing, the prudent investor would want to hold back the distributions to build up cash reserves until the property is more stabilized. This way, they don't prematurely start making distributions and then having to pull back, should the occupancy, drop a lot more than projections. Some sponsors, be aware that they will raise a lot of extra capital and start making distributions right away, sometimes paying sizable amounts or even close to the pref amount. Be aware that they're just paying investors with capital raised and not from cash flow from operations. Not only is this unethical, it is illegal. A return of capital is not the same as return on capital. It's important to make sure that the distributions are coming from cash flow from operations. You can find this out by looking at the actual financials to see how much cash is left over to distribute.